Today, my guest is Paul Caputo. Paul is with Segregation Holding. And Paul, welcome to CREPN Radio.
Thank you for having me here today, Darren. How's it going today?
We're good. We're good. Looking forward to talking with you about cost segregation. But before we do, if you would take a minute and tell the listeners and myself a little bit more about yourself and your background and your role at Segregation Holding.
All right. Well, I have been with Segregation Holding for a little bit over a year. I'm a cost segregation specialist, which means that basically I'm the one who can explain how cost segregation works to all of our clients. So with that, it's a very specialized industry, so I have to take a lot of time figuring out all the tax code, reading through all of that type of stuff so that I can, relay all that information to our clients.
Got it. Well, speaking of which, why don't we just start with what is cost segregation?
So cost segregation is basically a way to get a huge tax credit for owners of commercial property and rental property. That is the result of cost segregation. The actual way that it happens is that we have a construction engineers and architects. They go in, document the property so that we have all the assets documented, and then we can actually break down the property into its different components, and those components have different depreciable lives. So we, get the depreciation schedule properly based on all of those different components in the property. Some of those are going to have a 5-year or a 7-year or a 15-year depreciation, as opposed to the long life depreciation that is going to be on the entire building. That'd be a 39-year or 27.5-year with a rental property and a 39-year with a non-residential commercial property.
Got it. So essentially, you're able to give the investor the opportunity to accelerate the depreciation. Is that what I'm gathering?
Yes, absolutely. With this, the real benefit is that the depreciation on the property is being front loaded, which results in a very big tax credit or refund in the current year or in the next couple years, as opposed to having to wait to get that credit over a very long period of time and in small amounts. Instead, we get, a much larger portion of that depreciation up front or, within the next couple of years.
Got it. So if somebody's doing this, how does it work? I mean, I think of depreciation myself as one of those things that always shows up on your when you're working with your accountant.
Mm-hmm.
You go to do your taxes, and there's the acquisition price, and if you're not doing cost segregation, they usually apply, I think it's like 80% of the cost of the purchase to the structure, just kind of a finger in the air kind of approach. And then from there, they just kind of straight line it for whether it be 29 or, is it 27 and a half? Is that right? Yeah.
27.5 for a rental property and 39 for a non-residential commercial.
Right.
But yeah, that is normally the way that the depreciation is done. The reason why most people don't or do it that way is because that's just what their accountant says. All right, this is just what we're going to do here. The thing is that the IRS actually prefers to do cost segregation on commercial and rental properties. Now, with the actual cost that we're looking at, has to be the actual building cost. You were saying earlier about 80% of it goes into the building, and about 20% goes into the land. And with that, that's a pretty good average. But with that, that's always going to depend on what the tax assessor actually says the land is worth. So, if you've got a building that you paid $1 million for, if you do have 20% land value, then you're going to have $800,000 in the building and $200,000 in the land. But it could just as easily be that 30% is the land value. So you'd have 300,000 in the land and 700,000 in the building. So with that, it does totally depend on the area, what the building is, how much land the building is sitting on as far as getting those land values. But that's always going to be something that comes from the tax assessor or actually from a land appraisal. So with that, the land part is something that we do not look at with the cost segregation. Land is non-depreciable. The land is never going to wear out. The land's always going to be there. Well, at least according to the IRS. So that is a big part because that can actually have a pretty big difference. If we're looking at a property that has 40% land value, there's not as much that you can do with cost segregation as if you're looking at a property that has 15% land value. And again, that's going to vary widely across the country.
Got it. So, if somebody was engaging a cost segregation study from a firm like Segregation Holding, what can you take us through that kind of a case study of what?
So, as far as the actual process of getting cost segregation done, it is pretty simple for the client. It is pretty complex for us. But we and most other cost seg firms like to keep everything as simple as they can for the clients. The way we do it is we start off with a benchmark analysis, and that's just going to be from some basic information about the property. Basically, where is it? Location is going to make a difference, like we already talked about, as far as the land values on things, but also the location is going to make a difference in the actual cost of the study, because we have to get an engineer out to Hawaii. That's obviously going to be quite a bit different than we need to get an engineer out to Dallas, Texas. We have engineers across the country, but we don't have anybody in Hawaii. So the location is a big piece of it. Also, what is it? There's going to be a big difference between doing a 10-unit apartment building versus doing a fine dining restaurant or a golf course or, any other types of commercial properties out there. So what is it? Where is it? How big is it? Obviously, it takes a lot more work to do a 50,000 square foot property versus a 5,000 square foot property. So those are the big questions. What is it? Where is it? How big is it? And of course, how much did it cost? Of course, you can have a 10,000 square foot building that costs $5 million, and you can have a 10,000 square foot building that costs $2 million. With the depreciation, it is all really based on the cost of the property. And that means when you actually purchased it. If you've had a property for 15 years and now it's worth double what you bought for it, the IRS does not look at that as far as depreciation goes. So really, those are the things that we need to know just at the beginning to be able to say, all right, this is what we're going to be able to do for you. So we take that information and then we put together a benchmark analysis. That is going to show basically the two biggest questions that everybody always has with cost segregation, which is going to be, what is in this for me? How much tax benefits are we going to be able to get for you? As well as this is what the cost of the study is going to be. But yeah, generally with that information, most people are ready to go, okay, this is something that makes sense for us. Generally we're looking at benefits that are 5 to 10 times what the actual fee for the service is going to be. So with that, that's kind of the first step. Then after that, we have a engagement letter and that just goes over all the details of the study, and then it is time to collect the documents. With that is going to be basically every type of cost document available for the property, as well as like any architectural drawings, blueprints, Basically, anything that will help us substantiate the costs for the property, because that's what we're doing. We're going in and figuring out the cost for every single component. So once we have all our documentation, then we can actually start the actual work of the study, and that is getting out to the property, doing a site survey on the property. And with that, we are taking a lot of pictures, making sure we have everything fully documented. So with that, again, that depends on the property. If it's a small property, that might take an hour or so. If it's a large property, it could take all day to get all that documentation. With that, that's just so that once we get back to the office with everything, we have everything that, if the IRS ever says, okay, we have a question about that, we can go, all right, well, here's a documented photo of that asset. And then after the actual survey, then it takes approximately 4 to 6 weeks for us to crunch all the numbers. And that is getting every component, out of the property, and then we can assign a cost basis to each component. And then based on what the component is, we go, okay, this is a 5-year asset, this is a 15-year asset, or this is a long life 39 or 27.5-year asset. And then after we've gotten all those costs out, then we have to reconcile all those costs with the actual cost of the property. For example, say somebody buys a apartment building that was built in 1905, but they bought it yesterday. So obviously we know that this building was built in 1905, and some of the components may be original from 1905. But there's going to be a lot of the components that are new. There's probably been a renovation at some point in the property as well. So with that, we can actually look back and see, how much it costs to make a brick wall in 1905. That is information that we can actually look up. So we go from that as far as the actual cost, and then rectify that with the cost that the property was paid for. So with that, with something that old, there will be differences and stuff like that. But if a property is newly constructed, then we can actually just go off all the exact numbers from the newly constructed property. Of course, that is the best way to do it. But, most properties are not newly constructed. So after we have done all that rectifying of the actual costs, then we actually do a triple review process where we review, make sure that everything is correct, all the I's are dotted, all the T's are crossed. Then we have the study ready for delivery to the client. With that can depend if it is a current year acquisition or construction, then just our study is enough. The CPA can actually use all the numbers at the end of our study as the new depreciation schedule for the client. If it is a prior year acquisition or construction, the client will need to do a depreciation adjustment. And with that, there's a form, IRS form 3115, is a change in accounting method, but that's what is used for the depreciation adjustment. And that form would need to be completed, which is something that we include with our study. And that would need to be filed with the IRS. And then within 30 days, the client would actually receive their tax credit. That would be credited to their taxpayer account within 30 days from the filing of that form. And that would be anything that would be in a prior year.
Gotcha.
So that's basically the process.
Yeah. No, I was just sitting here thinking there's a couple of thoughts that came through. I did. The last one was that, the cost or the tax credit, I can't imagine you have a lot of resistance when you talk to people about this. When you're talking about saving, saving on taxes. Those tend to be pretty popular ideas with investors that I find. But a couple of questions that came up, that I'm thinking, on the different schedules. You said the 5, 7, and 15 years as far as accelerated depreciation. Are those opinions? I mean, can you vary in an opinion from, or is it pretty standard affair that like this, whatever this is that's a 5-year thing, or was there wait a minute here, that's a 15? Is there?
So that is a very interesting question, because the answer is kind of both. One thing with cost segregation is for many, many things, there are no bright line tests of this is this 100% of the time. It very much ties into what it is exactly, how it is used, and where it is, even sometimes as well. I mean, there are even different ways that you can install different components that will change, whether it is a 5-year asset or it is a long life asset. So with that is a lot more complex than I could really go into right here. But the thing is that every single thing that is reclassified, there has to be some reason for it. It's actually, there are 6 tests that were put out by the tax court. It's called the test from the Whiteco case. And those 6 things basically talk about the permanence of the component. And that is oftentimes used to say whether this is a 5-year component or if this is a long life 39-year. Just for example, just the molding, like baseboards, that is something that can be a long life asset or it can be a short life asset. It depends on how it is installed. If the baseboard is put on so that it is easily removable, like if it is tacked on, nailed on, or screwed on so you can get it off easily without damaging the baseboard or the wall, then it's a 5-year asset because it's easily removable. If you take that same baseboard and glue it onto the wall or cement it on somehow, that is something that is physically attached to the wall and not easy to remove from the wall. So in that case, that baseboard would actually be part of the wall and would be a 39-year asset instead of being a 5-year asset. So yeah, there are a lot of ins and outs.
Almost sounds like it could get kind of comical having the conversation with, I guess it would be an IRS conversation about whether or not it's permanent or temporary kind of thing. But interesting. The other question I've got is CapEx expense. Investors are a lot of times when they're doing their property analysis for investment, and they'll kind of plug in some numbers and stuff. It would seem to me that this could actually be or the numbers that you're producing could actually be useful in capital expense modeling for the buyer, the investor of the building, for budgeting and kind of having an idea of when they should or shouldn't, or does that make sense?
Yeah, absolutely. And that actually goes to one of the additional benefits of cost segregation. I mean, let's take something that everybody in real estate has to think about is, when are we going to have to replace that roof? Or are we going to actually do a replacement? Or we're just going to repair it and hope that that works out for the next couple of years? When you have a cost segregation study done on a property and you need to do something like replace the roof or, replace any component in the property, really, what the documentation of the study allows you to do is, going back to the roof example, let's say you bought a property 10 years ago and you have to replace the roof now. With that, the roof is a structural component. That's going to be a 39 or 27 and a half year asset if it's a commercial or rental property. So with that, it's a commercial property on 39 years, and you got to replace that roof after 10 years. You've got 29 years of depreciation left on that original roof. But you're removing it and you're putting in a new roof. What you're actually allowed to do is take that 29 years of depreciation that's left on the roof and expense that out all in the current year. And then with the new roof, you get a new depreciation schedule. So that is very, very cool when you have, large capital expenses like that you can actually expense out whatever's left on whatever you're replacing. If you're looking at a $200,000 roof and you've got 29 years left on it, you can do $150,000 approximately expense when you remove that roof and put on the new one. So, that's a huge, huge tax benefit that, is overlooked a lot of times.
And that's a specific benefit of the cost segregation, and that you're able to itemize the different components of the building to where you can and fully take advantage of those expenses, right?
Yes, absolutely. Because say you're in the same situation and you have not done a cost segregation study, you can't really remove the remaining depreciation on the roof because you don't have a basis for the roof.
Right.
Roof is still entangled with the rest of the building. So with that, we see where people do that, have the roof replaced, and then start a new depreciation schedule for the new roof. And that is actually a little bit of tax fraud unknowingly, because you're still technically depreciating that old roof because you haven't removed that basis from the entire building, because you can't. You don't have a way to do that without doing a cost segregation. So that's something where some people can get into a little bit of trouble if they're doing stuff like that. But it is a huge, huge benefit, especially, if you're going to have any of those capital expenditures.
Well, that's interesting because you mentioned that if you do buy a building and going in you're going to have to put a new roof on, and let's say it's a 5-year estimate, life expectancy or whatever, and if you've got your straight lines at 27 and a half, you essentially would miss out on the 22 and a half years of depreciation. You couldn't capture that, I guess. So if I'm understanding you right, if I go through the cost segregation model, you've got a starting point, says roof, and I guess my question for to make sure I'm understanding right, when you go through that thing and if I buy, let's just say I buy $1 million building, $1 million property, and if I don't do the cost segregation, my accountant says, okay, 200,000 land, 800,000 building, ready, go. Okay, we start the straight line depreciation. Or if I bring in your firm, and you guys go say, wait a minute, okay, well we break it all down, and for example's sake, let's say the roof's a $30,000 roof, okay. New. How would the fact that I've got, when you present the study, would you recognize that it's a 20-year life because that's what a roof is typically rated, or would you say no, it's only got 5 years left based on this?
No. So the way that works is like a roof specifically is a structural component.
Okay.
The roof needs to be there for it to be a building.
Okay.
So a roof is always going to be a long life asset. So it's always going to be a 27 and a half year in a rental. It's always going to be 39 year in a commercial property. So with that, a roof specifically is always going to be like that. But as far as a breakdown, like going back to, example of $1 million building, 800,000 actually in the building, 200 in the land. What we would do is we would be able to break that down. Say that it is really only 500,000 in the structural components of that building, and out of that other 300,000 that was in the building, we might have 150,000 that is the 5-year assets, that'd be the tangible personal property, and then maybe another 150,000 that would be the 15-year assets, and that would be all the land improvements. So
Gotcha.
really, the cost segregation breaks that property down into 4 categories, really. That is the land, which doesn't depreciate, the structural components, that's going to be roof, ceiling, walls, doors, windows, things that are the structure, the outer shell, basically, of the building, and then anything that's necessary for it to be a building. And the land improvements, that's going to be the stuff that gets the 15-year depreciation schedule. That's going to be all the stuff that is outside the building, that is not attached to the building, that is useful for the building. Those are improvements on the land. That can be stuff like sidewalks, landscaping, parking lots, signage, monuments, all that type of stuff that's outside. Like if there's carports and stuff, that would be a land improvement. And then all the tangible personal property, that's all the really good stuff because that gets the 5-year depreciation schedule. Some of it is 7-year, but most of it is going to fall into the 5-year category. There are a couple things that are 7-year, but most of the time we don't see any 7-year property. But yeah, the 5-year stuff is going to be all the stuff that is necessary for whatever that business is. Say we're looking at a restaurant. Most of the stuff that is in the kitchen is going to be a 5-year asset. All the equipment, all the furniture, all the fixtures, those type of things. But then what really is good with the 5-year is when we can get into some of the deeper stuff. That would be like the plumbing systems, the electrical systems. If these are systems that are supporting something that is a 5-year asset, those systems become a 5-year asset as well. So, again, like a restaurant, all the stuff in the kitchen, all the electrical and plumbing that is supporting everything that they need in there becomes part of whatever that system is. So with that, there can be a just huge amount of 5-year property in places that, people would never even think to say, okay, that's something that would qualify. And it does because it's only there because of that business. It's not there because this is what a normal building has. So really we break things down into those categories. And then, each component is listed itself as well. So, if it is a restaurant, they need to replace the hood in the kitchen. That's something that they can do very easily as far as depreciation goes because got that hood in there, 5-year asset. Then 3 years down the road, they need to replace it. They can expense out the remaining 2 years on that. And then when they put the new hood in, then we actually have the cost of the new hood, as well as the soft costs as far as the installation and everything. All that goes into the actual total cost of putting that new hood in. And then they'd be able to start 5 years on the new one.
Gotcha. Got a question I kind of want to dig into a little bit. As far as who can take advantage of a cost segregation study. And before I turn you loose with an answer there, it occurred to me, you mentioned the restaurant example. So if you've got even a landlord that agrees to build out the space for the restaurant tenant, and in that they build in that hood and whatever they may not put in all of the elements, but they may design a space that includes the hood and that kind of stuff. I'm assuming that would play into their or whoever owns that would benefit from that.
Absolutely. In a situation like that, and we do work with a lot of clients that are on both sides of stuff like that. It all does depend on who owns it, who paid for it. See a lot of times where the tenant just gets a blank space basically, and they have to do all of the build out. They do $300,000 worth of build out to make that blank space into their restaurant. Then we can look at that $300,000 that they put in there. If vice versa, it is the actual owner of the building who does all the build out, then those benefits would be for the owner of the building. It wouldn't change at all what those benefits are. It would just change who gets them. And it's always going to be who actually owns the assets, whether it be the whole building or just a build out. We've done a whole bunch of like coffee houses like Starbucks, where they're the corner in a little strip center, and just the Starbucks is all we do in that thing. Of course, we always like to try to get the whole shopping center if possible, but depending on, there might be 10 different tenants in there who all have different types of build out. And if something is too small, the cost benefit really isn't going to make sense. I was talking to a lady who owns a hair salon, just a very small salon, and she's only done about $15,000 worth of build out to turn that little space into her salon. On something that low, the benefit that she would get out of doing cost segregation would not outweigh the actual cost of doing that work. But as far as who can do this, it is really anyone who owns either commercial property, rental property, or tenant improvements. And with that, the other piece is that they need to have purchased it after January 1st, 1987. So if somebody bought a building back in 1986, we can't do anything for them with cost segregation. That was when the tax laws changed, and that was when everything started up anew with cost seg. So that is the time period. So the past 30 years is a pretty big amount of time. But really, you get the most benefits out of cost segregation when you are purchasing. But, a lot of our clients have owned their building for the past 5, 10, 15 years, and we're still able to get them quite a significant benefit. But yeah, as far as the buildings go with cost seg, this is something that scales up. So the bigger, the better, 100% of the time. And that's really a big reason why most people don't know about cost seg, or their CPA hasn't mentioned it to them, because most people think that you got to be looking at a building that is a $5 million, $10 million building to be able to do this. And that did used to be true. It used to be there were only large accounting firms that would do a cost segregation study they would start at $100,000 back then. So yeah, in that case, it only makes sense to do it on a $5 million or a $10 million plus building. But now things actually have progressed quite a bit. And there are firms like my firm that are small independent firms that focus on cost segregation and other advanced tax strategies. So you're not paying all the overhead and everything that a big four accounting firm has. So with that, we can look at stuff down to about $200,000 in cost basis for the property. That's usually the point where it starts to make sense as far as the cost to the benefit. Like I said, of course, bigger is better. Multiple properties is also better. Because, I mean, if you're looking at 5 properties that each cost $200,000, then, I mean, you've got about $1 million worth of cost basis for us to look at. But yeah, I'd say the minimum is around 200,000. We will personally look at anything. We've had clients that have, very low cost rental houses. I had one guy who had a portfolio of 16 rental properties, and they were all very low cost, all between $50,000 and $70,000. And because he had, a portfolio like that, we were actually able to spread the costs out for the study and be able to do all of those all at once for him. And, the benefit was not as much as it would be if, he was looking at $1 million building, but it was still a, good tax benefit for him.
Made sense, huh?
That was only because he had that portfolio of those small properties. If it was just one small property, I had clients who just sent me one small property, and I was like, we can't really just do one that size. It's really, the cost benefit for you is not going to be worth it. So that does happen, but that's only on very, very small properties.
Got it. Paul, this is, I always find it entertaining and actually hugely informative, just the, the benefits of how to lower your income and increase your expense through using the tax code, which is all perfectly acceptable, legal, and as you even identified earlier, is the IRS prefers the cost segregation as opposed to the straight line depreciation. Before we wrap this up, what's the one thing that you would recommend the listeners remember when considering cost segregation?
I would say the biggest thing to remember is talk to an expert. One of the biggest hurdles for the cost segregation industry is there is a lot of misinformation out there. Definitely make sure you're talking to people who know what they're talking about, who have used cost segregation, and have been doing it for a long time. One of the biggest things that a lot of people tell me is, my CPA said I don't have to do this, or my CPA said he already took care of it for me. With that, like I said, I hear that very frequently, and with that, that's always going to be something that is not to the level of working with an engineering firm. One big thing is that the IRS has said that for cost segregation to be applied properly, it must be done by people who know what they're doing specifically with cost segregation. And with that, you need to have knowledge of construction techniques, design, as well as estimation procedures to be able to do cost segregation properly. That is generally figured as a construction engineer or a architect are the two people who really have that type of experience and knowledge to be able to do cost segregation properly. So I would say that would be the biggest thing. If your accountant says, I already did a cost segregation for you, say, okay, your accountant is obviously looking out for you, trying to get you the most benefits. But there's going to be a huge, huge difference between looking at a building from an accounting perspective and looking at it from an engineering and architectural perspective. Like I was saying earlier about electrical and plumbing components, with that, that's something that would never be uncovered by just a accounting review of a property. So this is something that is very specialized, and it does require a specialist for it. So yeah, I would say that's the number one thing, because if there is ever any issue with the depreciation or the cost segregation, the IRS is going to ask you about it. They're not going to ask your accountant about it. So definitely make sure that you're working with somebody who knows what they're doing and has a very, very good track record.
Got it. That's a good note to end on. Hey, Paul, before we wrap up, what is the best way for listeners to get in touch or learn more about you?
Well, I am on LinkedIn, so you can message me there. Again, name is Paul Caputo. You can also email me. My email address is pcaputo, that is PCAPUTO at segregationholding.com. Or you can give me a call. My phone number is 720-744-2007. Again, that is 720-744-2007. Or you can take a look at us on our website, is segregationholding.com.
Got it. And for our listeners, I'll have all that listed in the show notes. So if you're driving and you can't write that down right now, don't worry. You can find it in the notes there and click on that and find Paul. Paul, thanks again for talking and taking the time to talk about cost segregation.
All right. Thank you, Darren. It's been a pleasure.
All right. And for our listeners, if you like the show, share the show with someone you know. It's real easy to do. So share our interview with Paul and let others learn more about cost segregation. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.